We all want our money to work harder for us,
Mm,
right? To build something secure for the future without that constant worry of big losses.
definitely.
But let's be honest, investing can feel, well, complicated, maybe even risky sometimes.
It certainly can seem that way.
So for this deep dive, we're doing something a little different.
Yeah.
We're actually going back in time, looking at some foundational ideas about smart investing.
That's right. We've dug up some really insightful historical material. And while, yeah, it was written in a totally different economic world, the wisdom in it feels incredibly relevant, timeless even. Our goal isn't, finding the next hot stock tip. Those rarely
Right.
last.
They come and go.
Exactly. Instead, we're really on a mission here to pull out those core principles, the things that can guide your thinking about investing, no matter what the market's doing today.
Yeah, the fundamentals. And our sources, they look at all sorts of investments from back then, different kinds of bonds, railroad, municipal, you name it, even mortgages, bank stocks.
A real variety.
But the real gold, like you said, is in those bigger ideas, the principles we can still use for our own choices now. Okay, let's dive in. What's the first big takeaway?
Well, the first really crucial point that jumps out from the sources is this common misunderstanding about returns.
Okay.
There's this natural error, as they call it. People who are used to making profits from, say, running a business, they expect similar high returns just from putting money into investments.
Ah, okay, like thinking because you made 30% selling widgets, your stock should automatically do the same.
Precisely. But there's a fundamental difference they're missing. The return you get just from money being invested, the pure interest or yield, it's generally much lower than the profit from actively managing something. That profit pays you for your time, your effort, the risks you're
That
taking.
makes sense. It's not just passive money.
Right. So the core insight is, if an investment promises returns that seem unusually high, it's very, very likely sacrificing safety in some crucial way.
That's a really clear warning sign, a definite red flag for those too good to be true offers. So if we shouldn't just chase the highest number, what should we focus on when we're looking at investments?
Yeah, good question. This leads straight into the 5 essential qualities our source really hammers home. These are the cornerstones for evaluating any investment. Think of it like a checklist.
Okay, 5 things. What are they?
First, the safety of your initial money, the principal and the safety of the income or interest it's supposed to pay. Second, the rate of that income. Third, how easily you can sell it, convert it back into cash. Fourth, the prospect of its value actually going up over time appreciation. And fifth, the stability of its market price. Does it jump around a lot or is it steady?
Okay, safety of principal and interest, rate of income, convertibility, appreciation potential, and price stability. That's a solid framework.
It is. And the key thing is every single investment has a different mix of these 5 qualities.
Right. Nothing has 100% of everything.
Exactly. A scientific investor, as the material puts it, consciously picks investments based on which mix of these qualities best fits their own needs and goals.
It's about trade-offs then.
Always. It's all about trade-offs. Like if you want a really high income stream, you might have to accept lower safety for your principal. Or if you need something you can sell tomorrow, like high convertibility, you might get a lower rate of income.
Okay, so you have to know what you're prioritizing. The source even mentions someone buying highly convertible stuff when they didn't even plan to sell it anytime soon.
Yes. That's a perfect example of not matching the investment to your actual requirements.
Yep.
You're paying for a feature, that easy convertibility that you don't actually need.
And probably missing out on something else, like a better return.
Precisely. You might have found another investment with similar safety and growth potential, but a better income rate, just because it wasn't quite so easy to sell instantly. So the core insight here is really, understand your needs first, then find investments with the qualities that match.
It really drives home that investing isn't, one size fits all. It's got to be personal.
Absolutely. The source uses this great analogy. Asking a banker for a good security without explaining why you need it. It's like going to a doctor and asking for some medicine without saying what hurts.
Huh. Yeah, that wouldn't work well.
Right. The advisor can't give good advice without knowing your specific situation, your goals.
So what are some of those different needs? How do they vary?
Well, the source breaks it down a bit. Think about a business investing its surplus cash versus an individual investing personal savings. Very different priorities.
Right.
And even for individuals, there's a big difference between someone who needs that investment income to live on versus someone who's investing for long-term growth and doesn't need the income right now.
Right. Let's unpack those. What about the business surplus? What should they focus on?
For a business with extra cash lying around, the main things are safety, how quickly they can get that cash back if needed, convertibility, and the stability of the investment's price. They can't afford big drops in value if they suddenly need the funds for operations.
Income is secondary.
It's still a factor, but yeah, generally less critical than safety and access. The key takeaway for businesses: safety, liquidity, stability.
Makes sense. They need that flexibility. Now, what about the person who depends on the income? Like a retiree, maybe?
For them, number one is safety of the principal, absolutely crucial. And then a reliable and hopefully high rate of income to cover their expenses.
Convertibility and appreciation are less important.
Generally, yes. As long as the capital is safe and spitting out the income they need, being able to sell it fast or seeing big paper gains might be lower priorities. So the core insight: safety and income are king.
Okay. And the flip side, the investor who doesn't need the income right now.
Their focus often shifts. They might look more towards a higher potential total return, and especially the prospect of the investment growing in value over time appreciation.
So maybe willing to take a bit more risk for that growth potential.
Potentially, yes, and quick convertibility might not be a big deal if they have a long-term horizon. The takeaway for these growth-focused investors: prioritize potential for high returns and appreciation.
Wow, just clearly defining those needs really changes the whole approach, doesn't it? It's like setting your destination before you even start the car.
Exactly, gives you direction. And once you've got a handle on your own needs, the next big principle is managing risk. And that means diversification, spreading things out.
Ah, the old classic, don't put all your eggs in one basket.
It sounds simple, doesn't it? But it's surprising how often it's not done properly. Real diversification isn't just buying, say, 10 different tech stocks.
Right.
It means spreading your money across different types of investments, bonds, maybe some real estate, stocks, and within those types too, like different kinds of bonds or properties in different areas.
So if you like real estate, don't just buy 5 apartments in the same city or even the same building.
Exactly right. Now, for a small individual investor, maybe diversifying across continents isn't practical, but for larger institutions, geographical diversification is absolutely critical.
Why is that?
Well, the source gives this really striking example: a fire insurance company in San Francisco. A huge chunk of their own investments was tied up in local San Francisco real estate and businesses.
Oh, I see where this is going.
Yeah. The 1906 earthquake hits. Suddenly, they have massive insurance claims pouring in, right? But at the exact same time, the value of their own investments gets wiped out by the same disaster.
Ouch, that's brutal.
It's a stark lesson. It shows how risks can be interconnected and why being too concentrated in one area, geographically or by industry, can be catastrophic. The core insight: spread your risk. Different asset types, different locations where it makes sense.
Wow, yeah. That really highlights why diversification isn't just like a finance buzzword. It's about survival. Okay, so know your needs, spread your risk. Let's dig into some specific investments mentioned. Bonds come up a lot, and the source says look beyond the coupon rate. What's that about?
Yes, this gets into the idea of the basis when dealing with bonds. Think of the basis as the true yield, the actual net return you'll get if you hold the bond until it matures.
Not just the percentage printed on it.
Right. It takes into account the price you paid for the bond, whether you bought it at a discount or a premium to its face value. Not just the stated interest or coupon rate, it's the underlying return.
Okay, so a 5% coupon bond could give you more or less than 5% annually, depending on what you paid.
Precisely. Because the intrinsic value of a bond, remember, depends on those 5 qualities we talked about: safety, income, etc. But its market price also gets pushed around by what the source calls accidental conditions.
Like what?
Things like the general level of interest rates in the economy or overall investor confidence. So, and when the source talks about the rate of income as a key quality, it means this scientific basis, the true yield, not just the advertised rate. Core insight. Look at the real yield, the basis, not just the coupon.
Got it. A deeper level of analysis. Now, one type of bond gets special attention: railroad bonds. The text even mentions a time of diminished confidence in them.
Yes, that was back in the early 20th century. There'd been some scandals, some public pushback against the railroads. a bit of skepticism.
Sounds familiar, different industry maybe, but similar dynamic.
Exactly. But the source argues that figuring out if a railroad bond was safe wasn't some kind of magic. It just required applying good business sense and looking closely at two key documents.
Which were?
The mortgage or trust indenture that spells out exactly what assets are backing the bond, and the railroad's latest annual report, its financial statements.
And the key safety principle was the margin of security. How much the assets were worth compared to the loan amount.
That's the core idea. And to figure out that margin, the source lists 5 specific things to check in those documents.
Okay, let's hear it.
1. Gross earnings per mile of track. You want to see the trend and how it stacks up against similar railroads. 2. How much debt is ahead of this bond per mile prior lien bonds? More of that is bad for your security.
Makes sense.
3. How much debt is behind this bond per mile junior lien bonds? More of that is actually good. It provides an extra cushion.
Interesting.
4. The ratio of transportation expenses to gross earnings. Back then, around 65% was considered normal. Big deviations needed scrutiny. Maybe they were skimping on maintenance or playing accounting games.
Right, digging into the operations.
And 5. Net income per mile. Again, look at the trend, compare it to peers, and make sure it reflects proper maintenance spending. The core insight for analyzing any bond, really? Get beyond the headlines, check the assets, check the earnings quality.
That's a serious checklist. Clearly requires doing your homework.
Absolutely. And the SNOS actually provides data from the government back then, 1906, showing that overall railroad bonds only accounted for about 53% of the total stated capital of the railroads.
So a lot of equity underneath them.
Yes, suggesting a pretty significant safety cushion for bondholders on average. And then more data from 1908, looking at big names like the Pennsylvania Railroad, New York Central. Even after a stock market drop, their bonds were generally less than 60% of the total market value of the company.
Reinforcing that safety margin. What else did railroad bonds offer?
Well, generally good convertibility, good liquidity, easier to sell than many other bonds and most stocks at the time, and also potential for appreciation.
How so?
Because railroads often reinvested earnings back into the business, improving the property, and they often raised new money by issuing stock, not more debt. Both those things made the existing bonds more secure over time, which could boost their value.
So despite some public unease, a careful analysis could reveal solid investments. Okay, let's switch to real estate mortgages. The source seems pretty balanced on these pros and cons.
Right. A mortgage is basically a loan secured by property.
Yeah.
Safety, again, comes down to that margin, the property value being well above the loan amount. Standard stuff like checking the title, taxes, insurance.
But there's a key difference from bonds.
A key disadvantage for the lender, the mortgage holder. You get your interest, great. But if the property value shoots up, you don't directly benefit from that upside. Your return is capped by the loan terms.
But if the property value falls,
then you bear that risk. If the borrower defaults and the property is worth less than the loan, you could lose money. It's different from, say, a railroad bond, where the market price might reflect increases in the railroad's overall value.
Interesting asymmetry there.
Because of that, the source advises buying mortgages, ideally when the property market looks favorable, values are reasonable, not overly speculative, and prospects for future growth seem decent.
What about income and liquidity for mortgages?
The main draw was often a higher rate of income compared to, say, government or top-tier railroad bonds. That was the big advantage.
And the disadvantage.
The big one was liquidity, or rather the lack of it. Entire want of convertibility, the source calls it. There was no easy, established market to just sell your mortgage quickly if you needed cash.
So very illiquid.
Very. But that illiquidity had an upside. Price stability. Because they weren't constantly traded on an open market, their stated value didn't fluctuate wildly day to day. That could be comforting in volatile times. The core insight. Mortgages offered potentially higher income but very low liquidity and stable principal value.
Okay, let's summarize the mortgage profile.
Right.
Generally safe, if chosen well in the right market, good income potential but hard to sell, no real appreciation upside for the lender, but stable principal. Sounds like they fit specific needs.
Exactly. That lack of convertibility made them generally unsuitable for, say, a business needing quick access to funds.
Right.
But for institutions like savings banks with long-term horizons, or maybe for a portion of an individual's long-term portfolio, that safety and higher return could be attractive, especially if bought when property values were low.
The source mentioned guaranteed mortgages too.
Briefly, where a financial company guarantees the payment. But it cautions that the guarantee is only as good as the guarantor, especially in a widespread real estate downturn. You'd need to look at their capital relative to the mortgages they guaranteed.
Okay, good points. Now, industrial bonds. These sound like they needed careful scrutiny.
Very much so. The source stresses that the safety of industrial bonds varied massively. You couldn't just paint them all with the same brush. It required deep individual company analysis.
What kinds of things should you look at?
Several key factors: the real value of their physical assets, conservatively appraised; their financial health right now, things like current assets versus liabilities; quick assets relative to debt; their earnings track record, are they stable, growing, comfortably covering debt payments?
So the fundamentals of the business itself.
Absolutely. Also, the structure of the bond. Did it have features like a sinking fund to gradually repay the debt, addressing depreciation, and critically, the quality of management, their reputation, their ability?
A lot to unpack for each one. What was the upside?
Generally, a higher rate of income compared to safer bonds like municipals or top railroads. That was the compensation for the potentially higher risk and the need for more analysis.
And convertibility. Easy to sell.
It varied hugely. Bonds from large, well-known industrial companies might be quite liquid. Those from smaller, obscure firms could be very hard to sell. Potential for appreciation was also highest in the larger, maybe more speculative issues. But as a class, they didn't offer inherent price stability like, say, mortgages. Core insight: industrial bonds demand thorough, company-specific homework. Higher potential returns come with diverse risks and liquidity.
Makes sense, given how different industrial businesses are.
Hmm?
What about public utility bonds, electricity, gas, water companies?
These had their own unique elements. You still needed to assess the physical property, ideally with an engineer's valuation. But crucially, you also had to evaluate their franchise, their right to operate. Is the franchise perpetual or for a limited time? Is it exclusive? What's the company's relationship with the local government and the community? Are regulations stable? That franchise value is huge.
So a political or regulatory angle there, too.
Definitely. You needed to look at their earnings after allowing for adequate depreciation of their assets and consider political risks, potential fare reductions, tax hikes, issues with franchise renewal.
Sounds complex.
Yeah.
How did their returns and liquidity compare?
Generally offered incomes similar to good industrial bonds, so more than top railroad or municipal bonds, but their convertibility was often lower than railroad bonds. The source advises prudence here, given the potential friction between public service expectations and the company's need for profit. Core insight: for utility bonds, assess both physical assets and the crucial franchise regulatory environment.
Good advice. Okay, nearly there. Municipal bonds, cities, states, these are usually seen as super safe, right?
Yes, their safety generally comes from the government's power to tax. The bond is essentially a claim on future tax revenue. So as long as the government had the legal power to tax when it issued the bond and the community remains viable, the principal and interest are usually considered very secure.
What should you check?
Key things were the ratio of total debt to the assessed value of property in the municipality, the specific purpose of the bond issue, and confirming the legality of the whole process.
And income. Liquidity.
Income varied with market rates and the issuer's standing. Convertibility depended on the size and reputation of the town or city and how much debt they had out there. An interesting point the source makes is that less actively traded municipals often held their value well during market panics.
Stability again.
Yes. But for individual investors, the source suggests they might actually find similar safety but potentially better income in well-chosen railroad or corporate bonds. Core insight: municipals offer high safety via taxation, but maybe not the best return for individuals compared to other options.
Interesting perspective. Okay, before we wrap, the source briefly mentioned stocks, especially bank stocks, and also the bigger forces moving markets.
Yeah, on stocks generally, it noted a legal trend maybe pushing them towards being viewed more as investments, providing a reasonable return rather than just pure speculation vehicles. But it singled out bank and trust company stocks.
Why them?
Because of their common practice of reinvesting a good chunk of their earnings back into the business, not paying it all out as dividends, this meant their book value tended to grow steadily over time.
Compounding internally.
Exactly. So even if the dividend yield wasn't super high and they weren't always easy to sell quickly, they offered a strong prospect of long-term appreciation through this steady buildup of intrinsic value. Core insight for bank stocks, then: steady long-term growth potential via reinvested earnings.
A different kind of appeal. Okay, last big piece. What moves the whole market? the big picture factors.
The source really stresses that understanding the general economic weather is vital for successful investing. It boils it down to two main drivers influencing security prices.
Which are?
First, the loaning rate of free capital, basically, interest rates. How expensive is it to borrow money? Second, the general condition of business, is the economy strong or weak?
Interest rates in the economy.
Okay. Low interest rates and a healthy economy tend to push prices up. High rates and a weak economy tend to push them down. But here's the tricky part. These two forces don't always move together. Sometimes they pull in opposite directions.
Ah, that's why it can seem confusing.
Exactly. That interplay can make different types of investments move differently at the same time. It contributes to that feeling of randomness. For example, maybe interest rates are low, which is good for bonds, but business is terrible, which is bad for stocks.
So different effects on different assets.
Precisely. High-grade safe bonds might rise in that scenario because of low rates. Speculative stocks might fall because of the bad economy. Middle-grade stuff might stay flat. It depends on which force is stronger for that particular investment.
But it's not totally random. There are patterns.
The source argues yes. The combined effect produces definite and regular swings, cycles. It describes the typical business cycle. Prosperity leads to maybe a crisis, then depression, then recovery, then back to prosperity.
And interest rates follow a pattern too.
Generally, yes. Rates tend to be low after a crisis, then rise as business recovers and booms, then maybe spike before things turn down again.
And these cycles drive the markets.
Largely, yes. High-grade, safe investments often do best when money is easy, low rates, and businesses may be slow, their safety is appealing. They might fall when rates rise and the economy booms as investors chase higher returns elsewhere.
And the riskier stuff.
More speculative stocks and bonds tend to get hammered in a crisis or depression but can rise dramatically during the recovery and boom times. The key is understanding how these two big forces, interest rates and the business cycle, influence different types of securities and trying to gauge their relative strength at any given time. Core insight. Market movements aren't random. They're driven by the interplay of interest rates and the business cycle, affecting different assets differently.
This has been, wow, an incredibly rich deep dive. It's so clear that solid investing isn't about chasing fads or getting lucky. It's about, well, grounding yourself in these fundamental principles.
Absolutely. Understanding your own needs, diversifying properly, analyzing the actual investments, and being aware of that broader economic picture.
Exactly. And even though the specific investments and market conditions are totally different today, these core ideas, they feel just as relevant. They provide that solid framework.
They really do. The underlying logic holds up remarkably well.
So as you, the listener, think about your own investments, maybe take a moment. Reflect on these principles. What are your real goals? Are you diversified effectively? How well do you understand the qualities of what you own?
Yeah, really connect it back to your own situation.
And maybe ask yourself, how can understanding these historical perspectives, this timeless wisdom, help you make more resilient financial choices? In today's, let's face it, pretty fast-moving and complex world, definitely some food for thought there.